Ministry of Education. Also, I welcome our principal, Dr. R.B. Patil, sir, my dear faculty members, students, to this IIC session on angel investment and venture capital funding opportunities for early stage entrepreneur. In the evolving landscape of entrepreneurship, understanding the intricacies of securing vital resources is paramount. So, a session dedicated to exploring angel investment and venture capital funding opportunities for early stage entrepreneur that serves as a beacon of knowledge in this journey. So, this preamble delves into the significance of such a session, highlighting its role in illuminating the path that ambitious entrepreneurs that country to transform their ideas into flourishing enterprises. So by delving into nuances of angel investment and venture capital funding, this session opens the doors to a realm of possibilities and guiding emerging innovators on how to secure not only financial support but also strategic partnership that can propel their startup towards unprecedented success. So these sessions focus on demystifying the funding landscape and shedding light on the symbiotic relationship in between the investors and the entrepreneurs promises to inspire, inform, and empower the next generation of business leaders. So with this brief preamble, once again, I welcome ma'am to SAOP platform. Thank you. Over to you, Rucha.
Thank you, ma'am. Now I invite our principal, Dr. Rajesh Patil, sir, to give the opening remark and welcome address. Over to you, sir.
Yeah, thank you, Rucha. At the outset, I would like to extend our warm welcome to Dr. Manjit Kaur, Madam, and we sincerely appreciate she accepted our invitation, and today she has agreed to guide my student about angel investment and venture capitalist funding opportunities for early stage entrepreneurial journey. I hope today's session students will have in-depth understanding of these kind of funding opportunities for their maybe whatever they have thought of the startup journey. And I would like to add few things that Madam Manjit Madam, that our Institute Innovation Council, since its establishment, it has emerged as one reputed IIC in Western region. Our students from third or final year students, they have their good ideas, and we would like to have the experts like you to guide the students so that they understand how these enterprises will be built in future. So with that hope, I think students will enjoy today's session. Once again, I welcome you, madam, and this session is open to students. Thank you very much. Over to you, Rucha.
Thank you so much, sir. I now invite Mrs. Suvarna ma'am to introduce our speaker to us. Over to you, ma'am.
Thank you, Rucha. Good afternoon, everyone. I am happy to introduce you to today's guest speaker, Dr. Manjit Kaur. In the year of 2011, she has qualified UGC NET. She has been awarded doctorate degree in 2018 in management from Punjab Technical University. Dr. Manjit Kaur is a dedicated and experienced academician with zeal for research and providing quality education. Currently, she is working as Associate Professor at University Business School at Chandigarh University. She has over a decade of experience in the higher education sector. Her research interests revolve around fintech, sustainable finance, and social marketing, where she has contributed significantly. Her dedication to research is evident through an impressive portfolio of 42 research papers published in renowned international and national journals, including Scopus, ABDC, WS, and UGC Index journals. Beyond her research accomplishment, Dr. Kaur's passion for innovation and entrepreneurship development shines through. She actively engages in fostering innovation and entrepreneurial spirit among her students and colleagues. This dedication has also led her to earn the title of Innovation Ambassador by the Ministry of Education. Congratulations, ma'am. Further highlighting her influential role in promoting educational advancement. She has presented many papers in international and national conferences and seminars. She has 2 books to her credit as well. She has 3 patents to her credit. She is entrusted with her editorial responsibilities for several esteemed journals, including those indexed by ABDC and Scopus. As a reviewer, she plays a vital role in maintaining the quality and rigor of academic publication. She has acted as a resource person in many seminars and workshops. She has also received International Researcher Award 2021 by International Institute of Organized Research. With this brief introduction, I would request to our guest speaker to take over the session. Over to you, ma'am.
Words. First of all, I would like to thank organizers, Principal Sir, our Principal Sir, Dr. Rakesh Patil, and organizing committee and management of Singhad College of Pharmacy, especially institutions innovation cell, for giving me this opportunity to come and interact with students of your college on a very important topic, that is angel investment or venture capital funding opportunity for early stage entrepreneurs. See, this topic is very relevant nowadays when India is seeing a boom and new startups are coming up, and now students, we can see new startups coming up at higher institution level, where students, they are coming up with new ideas, want to grow in life, but at that time they are not having much of funds. They need funds, although they have zeal for this, although they are having good innovative ideas, they want to do something, but the only main hindrance that they have to face, that is related to fund. So that is why this today's session is important, so that all those students or even faculty who are interested in any startup, they should know from where they can get funding for their startups. So with this, I'm just going to start my lecture, and I'm just going to share one PPT, and then we can start. Okay, so I hope is it visible to all?
Yes, ma'am. Is it visible? It is visible.
Thank you. So today's topic is on angel investment or VC funding opportunity for early stage entrepreneurs. And now let us understand what is basically venture capital. So venture capital, or in short we call it VC. So venture capital, see, mostly what we are aware about, that the various sources of raising funds, that is by going to different banks, or by raising funds from capital market, by through IPO. But even when a company is going ahead with IPO, it should be established enough to go to such limit that it has to issue prospectus, and then it has to comply with the regulations of Security Exchange Board of India. then only it can raise capital through IPO. And even already established companies like Paytm, so they have their IPO after they were established. So having IPO, I don't think that's a good option for startup. And even for banks also, banks look for some, because startups are usually people or business ideas or business models or some products which are very innovative. And usually banks, they look for secure projects where they are sure, yeah, this project will work, then only they give funding. So that is why these startups, they face this issue that whenever they go for funding to banks or already the traditional methods of funding, so at there they are facing a lot of challenges. The challenges there due to the fact that the product or the business model that is innovative, that is something different. So that is why banks, they just shy away from giving them loan, and moreover they also ask for some security, so which is not possible for a startup to get. So that is why, so for these startups, these angel investors, venture capital funds, they are better option. So what is basically venture capital? Venture capital or VC firms, they are basically companies that invest their funds into early startups in which they see the potential for growth and profitable business. So when we say venture capital funds, their main focus itself is on new ventures. So venture capital firms are those companies which venture capital firms are those companies basically which provide funds to these new companies, to startups only. So basically venture capital firms, they they give funds to those people to whom traditional, which are not able to secure funds from traditional sources like banks or from capital market. So basically venture capital firms, they are the one who give this who give funding to such type of new innovators, to these startups. So basically venture capitalists, what they do, their main aim is to help startups to grow, to scale up. So venture capitalists are always they're always looking for some new startups, some innovators who are coming up with some new ideas. Okay, so what they do, they help these startups to increase their scale of operations. They also help them in boosting their client base, and help them in securing more profit. So what is this? When I'm saying venture capitalist, I'm saying that they always look for startups. So these venture capitalists, they give you can say they provide funds to these startups, but for that they do not they are not long term. They do not keep the money for a long term in those funds, because they know, see how they work. They know that these, whenever there is an innovation disruption, then there is a huge scope of making profit. So they invest in these startups and in these companies. They do it for their capital appreciation. For example, if they are investing in a particular startup, and at the initial stage, they will be giving them funds in exchange for shares. The share value will be less, but in future they foresee that in future when the startup will develop, so the share capital price will also increase. When the share capital price increases, so at the time they sell those shares and they earn profits in that. So they get capital appreciation. So this is the basically the rationale behind venture capital firms to invest in startups. So this is a you can say boon for startups. It's a win-win situation for both venture capitalists and both for startups. So basically, when startups they go to venture capital firms, venture capital firms help them in scaling up their operations. They give them funding so that they grow, and by scaling up and growing in size, they get economies of scale. And here, so as I already told you, the venture capitalists, how they benefit here. These venture capitalists, they benefit through capital appreciation, okay, because they have made investment in that particular business, and that when this startup, when it grows, they also get capital appreciation, because the market share of that venture will also grow. Okay, so basic, and moreover, these venture capitalists, they are looking for those startups or those companies and entrepreneurship ventures where which are still in their infancy phase. It means which have just started. They are in their initial phase. Okay, because they know, these venture capital firms know that these are just startups. They are in their initial phase. They need funding. So at that, they are able to secure their shares at a lower price. So that is why they target for those firms and those startups which are in their initial phase only. And some important features of these venture capital projects. It means, so when venture capital firms, when they're looking for projects, what type of projects they are interested in investing. So basically, these venture capital firms, they are looking for those ventures or those avenues where there is high risk, because high risk businesses, traditional these funders, traditional investors, they will not invest in high risk projects, but venture capitalists, they always invest in high risk projects, because the risk is directly proportional to return. If there is high risk, it means there are chances of high return. Okay. So one of the feature of venture capital projects is that venture capitalists is that they are looking for high risk projects for which usually traditional funding is not available. So that is why these venture capitalists give them funding, and they are able to get shares of these startups at lower price. And these venture capital projects are also those having lack of liquidity. These venture capital firms also invest on those projects which have less liquidity. They are short of cash. They are short of cash. It means that these venture capitalists, then they can get a good deal out of them. Okay? And these companies, startups, or these new entrepreneurs, innovators, they go to venture capitalists because they know that they will fund them. And another point here is, that they have long-term horizon. So when venture capital firms, they invest in those projects which has long-term horizon. Long-term horizon means which will continue for a longer period of time. Okay, so they are basically looking for those ventures which will continue for a longer period of time, because they know if they invest in these ventures which will continue for a longer period of time, long span means they will have more years for the capital appreciation. Okay, so long, and they invest in these companies for a longer term, so that they can get capital appreciation. For example, a venture capitalist, there is some new fintech startup, they have developed some new app, so they need funding. They can go to venture capitalists, and venture capital firm can give, for example, they are securing their shares for 10 rupees per share, and they're giving them, for example, they're giving them 50 lakh, they're giving them 50 lakh funding, 50 lakh funding for 50,000 shares of 10 rupees, 5 lakh shares of 10 rupees each. So what will happen in future? Maybe after 5 years, then 10 rupees share becomes around 100 rupees share. Then for that 50 lakh, they will get 5 crore. So this is how they are looking for long-term horizon projects where they will earn profit in the longer term. So another feature of venture capital projects is that they are looking for equity participation in capital gains. As already told you, that venture capitalists, they are not, whenever they are giving funding to these startups, they're not looking for, they're not asking them like, yes, we're giving you loan, you have to pay interest. No, it does not work like that. These venture capital firms, they are giving them funding, and for that they are taking equity participation. They are getting shares in that particular startup or company. Basically, what they are looking for, they are looking for long-term capital gain. And another feature of venture capital projects is that they are basically innovative firms. They are innovative firms. It means that they are doing these basically startups are based on something innovative. They are doing something out of the box, which is not being done by other people, and they are doing some novel ideas, some new product, some disruptive idea. So basically, venture capital firms invest in those projects only which are innovative. And another thing what these venture capital firms are looking for, they're looking for management participation. See, if they are investing in a company, they also need say in the management. They want participation in the management of these companies as well. So these are some of the features of venture capital projects: high risk, lack of liquidity, long-term horizon, equity participation in capital gains, innovative projects, and management participation. Now let's look at types of venture capital funding. See, the various types of venture capital are classified as per their application at various stages of a business. We classify this venture capital fund according to at what stage of business the funding, they are giving the funding or they are asking for the funding. And the three principal types of venture capital are early stage financing. As the name itself says, that early stage financing, it is done during at the early stage infancy phase. Expansion financing, when startup is thinking of expansion, at that time it is going to venture capital firm for funding, so that is expansion financing. Acquisition or buyout financing. Acquisition or buyout financing, it is when venture capital, when startups, they want to acquire some other company, right? So at the time they go to venture capitalist for the funding. So these are the three main types of venture capitals, depending upon the stage of business or the application, like early stage financing, expansion financing, and acquisition of buyout financing. And the venture capital funding procedure gets completed in 6 stages of financing corresponding to the periods of a company's development. So basically, these venture capitalists, they give them funding in 6 stages. As the company develops, so with this, they also infuse funding in that venture. So these are the different stages when this venture capital funding is done. First of all, there is seed level, seed money. Seed money, usually as a student, students are listening to this lecture. So what they're looking for, if they have any startup idea, so at this stage, you all are looking for some seed money. So you have some innovative idea, right? But you are not able to, you do not have even funding for making your prototype. So at this time, for prototype or for start having beginning only, you need some money for taking your idea to the next level. So that is seed money. So at this time, at this level, the seed money is given to the startups, to the innovators, for preparation of their prototype, or working on the feasibility study and other study, or doing research, and making the prototype of their product. So seed money is basically low-level financing for proving and fructifying a new idea. And then next stage is startup stage. So startup stage is now the startup, the innovators, they have with help of some seed money, they have analyzed, or they have done their you can say feasibility analysis. They have made some prototype. So now they need funds for expenses, because now they are going to start the business. So when they're starting the startup, they're starting the business. At that time, they need money. This is startup stage. So new firms, they need funds for expenses related with marketing and product development. So this funding is given by venture capitalists. Then there is first round. Next level of funding is first round. So this is for manufacturing and early sales funding. This funding is given for covering manufacturing expenses and for covering early sales funding, like the initial sales funding. Then there is second round. Second round is this is operational capital given for early stage companies which are selling products but not returning a profit. So already the company is making sales, but it is not able to get profit. So at this stage, it is getting another round of funding, so that it can, because as it is not able to earn enough of profits, so at this stage it needs more funds to cover its operational expenses, right, and to do more marketing. Then there is third round. Third round is also known as mezzanine financing. And here this is the money for expanding a newly beneficial company. Now this is mezzanine financing is required for a company which is expanding for expansion's sake. Okay, so third round, that is mezzanine financing, it is money done for expansion. And then the company is doing good, but now it likes to venture into some new markets, some new product lines. So that is third round. Then we have fourth round. Fourth round is also called bridge financing. So it is for going public. It means doing mass production, mass marketing. It means going public process, right? So that is fully commercialization. For fully commercialization, the funding required, that is fourth round. So basically, this venture capital fund is given in these 6 phases: seed money, startup, first round, second round, third round, and fourth round. Now, what are the advantages of as a startup? If you have your own startup, so what are the advantages of taking money from venture capitalists? First of all, startups are able to give to get large sum of finance, equity finance, right? So one of the main advantage of availing this venture capital funding by the startups is that they can acquire large amount of funding, and they do not have to give any interest on that. They only have to give equity for same. So another advantage is that venture capitalists are rewarded by business success and the capital gain. These venture capital firms, what is the benefit for them? Their benefit is that as they have got equity in that particular company, startup or venture, so if that startup becomes success, it is success for the venture capital firm, and in the long run, if they keep it for the long run, the capital appreciation will be there, the share capital value will be increasing, so they get capital gain, right? So another this advantage of venture capital for the startup, it is that they are able to bring wealth and expertise to the company. See, as I told you, one of the characteristics of venture capital is they, apart from getting equity, they also want to participate in management. So they will be, these venture capital firm, it will be participating in management decisions of the firm. So their expertise that will be useful to the startup. Okay, so that will be along with the funding, they're also bringing their expertise, their skill, which is very beneficial for their startup. So another positive point of using venture capital is that venture capitalists, they are usually established businesses, and they have a wide network of contacts. These venture capitalists, they have wide network of contacts. So they have their own contacts, which can be very useful for these startups. And once they have taken money from these venture capitalists, so in future also in the business, if they require some more funding, additional funds, they can get it from the same venture capital firm. So these are the advantages of venture capital. It provides large sum of equity finance. Venture capitalists are rewarded by business success and the capital gain. They're able to bring wealth and expertise your company, and the venture capitalist also has a wide network of contacts, and they also provide additional funds. So this was about venture capitalists. Now let us discuss about angel investors. So what are basically angel investors? So sometimes we use them, angel investors and venture capitalists. You can say we can use them simultaneously, but there is a difference between angel investors and venture capitalists. We will discuss that also. So basically, an angel investor, they provide capital for small startups. They do not, angel investors, they do not invest, they do not give a huge amount, and they usually invest in small startups. Angel investor provides capital for small startups, and again, these angel investors, what they're looking for equity from those startups. And the financial backing they provide may only be a one-time investment. So they are not giving these angel investors, unlike our venture capitalist firms, they are not giving it in phases. They invest only at one time. Okay. Either these angel investors, either they invest in their initial phase for seed money, or they can give investment when there is already existing startup and they want to expand. They can give at that, and basically higher return on their money, and they're looking for a good return. Like they feel that if they invest the same money in stock market, they will not get good return. So it is better to invest with some startup where they will get capital appreciation. They will get their stocks at low price, and later they can sell it on when the stocks prices are high. So basically, angel investors, when I'm saying venture capitalists, they're usually firms, but angel investors can be people. The people who like to invest in innovative projects. So the main focus is innovative projects only. So the main difference between angel investors and venture capitalists, angel investors, they provide smaller sums, for example, about $50,000 around. Venture capital, they and these are comfortable, and it is easier to there is not a long process for giving funding also. They do not do that much of due diligence. But on the other hand, venture capital firms, they have a lengthy diligence process, and it's a complex process because they they do proper evaluation of the investment decisions. And venture capitalists, they can give larger sum also. So another difference is that angel investors, they have a quick investment decision. Usually, angel investors, they are persons. So it's a quick decision on their part. Only after 1 to 2 meetings with the startup, they can give the money. But on the other hand, with venture capitalists, they invest large sum into business, and they take lengthy process to get money from them. Okay, and another this difference is that angel investors, they are not looking for any role in the management. They do not any control. Okay, They only do funding. But on the other hand, venture capitalists, they want seat in the board of members, right? They need a say in their, they need say in the management. Another tip point is that angel investors, they have their simple term for investment. They only at one time, they do one time investment. What they're looking for, that in future they will get good return for that. But on the other hand, venture capitalists, they are making payment and they can invest again in the same. They can give money in phases, but they also give expertise also. Venture capitalists provide their expertise also, and venture capital firms, they also get involved with these venture capital firms. They also get involved in this startup. And the funding process. So whenever a startup it wants to go ahead for funding, what is the process for that? So the venture capital funding process typically involves four phases in the company's development. One is idea generation, startup, ramp up, and exit. Okay, so these are the different development phases of the startup where they can get funding from venture capitalists. The idea generation, they get seed money, as already discussed. When they're starting, then they get startup money and round 1 money. At ramp up, they get round 2 money, round 3 money, right? So this is the funding process. And now, as a startup, as a innovator, as a promoter, if you want to go to these venture capital firms or angel investors, so what you should keep in your mind? The checklist before you reach out to these investors. First of all, you have to prepare a pitch deck. So you need to prepare your pitch. You should be well prepared. So the key points that you need to mention, see, whenever you're going to a venture capitalist or angel investor, you have to pitch your business idea. You have to pitch your product, your innovation. So the key points that you should keep in that, they are given on the screen.
Ma'am, you are not audible.
Okay, I'm sorry. So for preparing a pitch deck, there are certain key points that pitch deck should include, like the company overview, the problem and how to solve it, product details, team overview, basic numbers, like what is the, so basically it must include what will be the company all about, and what is the problem that this company is going to solve, right? So the problem this company is going to solve, and because usually every innovation starts with identification of some problem and providing solution first thing. So what is the problem and what solution they are providing to the customer? The product details, team overview, who all are part of that startup, and basic numbers. Basic numbers means basic calculation, how much costing is there, what is their projection, for the revenues. So all these all these numbering, they should be clear about that. In the pitch, they have to give this. And in the pitch, they should also mention the competitive analysis and USP. What is the unique selling proposition that they're giving? What unique their product is from their already existing competitors, right? And how much funding they're asking. So this all should be part of a deck. So I request all of the students to please take screenshot of this, because this checklist is going to be very useful for you if you're going ahead with your startup ideas and what all you have to keep in mind while you are pitching the same, right? So first is your pitch should be complete. Then you should also have a business plan. Another checklist is that you should create a business plan. And some of the key points that you should keep in your mind for creating a business plan is that you should avoid overstating business plan numbers. Please do not please do not be overconfident. Do not give inflated figures that yes, we can make so much profit. Do not be over positive. Do not overstate the figures. Do not overstate the profit figures. Okay, because even when you go to these investors, they're looking for some believable figures. They're usually experienced and they know how the business will work out. And in the business plan, one important key point that should be kept in mind is that fund usage should be clear in the plan. The fund usage should be clear along with the areas where they're going to use that fund. And another point is that they need to shortlist invest. They have to shortlist. First of all, when they're going out to reach to their investors, they should know to whom they have to reach. See, basically, who are these venture in? I know about. I'm from Chandigarh. I know there are certain businessmen who are venture capitalists in their area, or who are the angel investors. Similarly, in your area, in Pune region also, you must look for which are companies, which are the venture capital firms, which even some normal companies, they also make investment. They are also venture capital firms. They also like to invest their money. And who are the angel investors? So one important point here is that one should shortlist the investors. So as a innovator, when you're going to pitch for your startup, you should shortlist investors who will invest in your venture. So this is very important. So before you reach out to investor, you need to prepare a pitch deck, you need to create a business plan, and you need to shortlist your investors. And how you should raise this money, you should take what is the competition, advisors and mentors. So how you should reach to these investors. How you will reach to these investors? You can reach to these investors through some connections. You have some connections, or you will come to know it from competitors, or you might be having some mentors or advisors, or you can send some emails to some business companies. You might get some reply from them. So this is how this approach you can take to raise money. And the pitch, how you will pitch, it can be the elevator pitch. Because these businessmen, they are always busy. You can tag them in some elevator while they're walking. You can give them a pitch in the elevator, or you can give them pitch in a way of a story, or if they will give you time, you can give the pitch in a PowerPoint slides. And if you get the opportunity to pitch them what solve and why does the problem persist, and the market size and potential to grow over time. And you should talk about the solution of this problem, what are the current solutions, and how your solution that you're providing for that particular problem, how it is different, what you're currently having, and what technology you're going to use. And you should talk about competition also. When you're pitching your idea, you should talk about competition. Who are your competitors? You should complete competitor analysis, and you should also tell what unique your idea is from the already existing competitors. And your business model, it should talk about how will you get customers, how will you make money, how much will you make per customer, what is the cost of providing the service or product, what is the cost of customer acquisition. This should be addressed by you in the pitching. And you should also talk about pilot clients or revenue and operations. It means some clients which you've already spoken to. You should talk about your product or service status. You should talk about press report, references, website performance, or any other achievement you have done so far related to your startup. And now here I would like to mention some common pitfalls that you should avoid. You should avoid like not preparing for the series or post seed or angel round. You should prepare for everything, and you should avoid starting the fundraise process too late, not identifying the right investor, and not being ready for due diligence. So today we discussed about angel investment, and we discussed about venture capital. We discussed about the checklist when you're going ahead with investment, what you should do. So thank you so much. I hope this session was useful to you.
Thank you so much, ma'am, for your valuable insights. We will now start with the question and answer session. Does anybody have any questions? You may feel free to ask.
Yes, student, anyone?
Hello, friends. Do you have any questions? Okay. Proceeding. I now invite Ms. Rutuja Moye, ma'am, to present the vote of thanks.
Thank you, Rucha. Am I audible?
Yes, ma'am.
Okay. Good afternoon, one and all. I, Rutuja Moye, Assistant Professor, Siaghad College of Pharmacy, feel honored to propose vote of thanks on the behalf of Siaghad Technical Education Society's Siaghad College of Pharmacy for today's session. My heart fills with lots of gratitude and respect to our guest speaker, Dr. Manjit Kaur ma'am, for not only sparing their invaluable time but also enlightening us with her commendable talk. Thank you so much, ma'am. My sincere thanks to our Honorable Founder President, Professor M.N. Navle Sir, Founder Secretary, Dr. Mrs. Sunanda Navle Ma'am, Vice President, Mrs. Rashna Navle Ashtekar Ma'am, and Vice President, Mr. Rohit Navle Sir, for their continuous motivation. My humble thanks to our Principal, Dr. Rajesh Patil Sir, for their continuous encouragement and support to arrange such type of these sessions. I would also like to thank Dr. Sadhna Raut ma'am, IIC convener and activity coordinator Mrs. Suvarna Vakare ma'am, and to the teaching and non-teaching staff of the SCOP and to their students who contributed to make this session successful. Thank you everyone.
Thank you.
I
Thank you so
request
much.
everyone to turn on their cameras for a group photo. Thank you so much, everyone. Thank you, ma'am.
Thank you.